All right, everybody, this is not going to be a fun update for me. I own Crowdstrike stock. About to show you my portfolio in a minute so you can see my real position in Crowdstock. They just reported earnings. The shares are down 19%. I'm going to talk about the report, everything that I think investors need to know, and then what I'm planning to do with my shares. Am I going to sell? Am I going to buy more? Am I going to hold? What am I going to do? All right, first up, my portfolio. You can see we got hit today. We're down $1,200 all time, down $23,000. We're now at $109,800. And here's Crowdstrike down. I've got a $7,348 position right now, down $1,700. And it's actually going to be down a lot more than that because this was when shares were at 138. Right now they're trading down to 112, which is a $26 difference. And so if you multiply 26 by 53, we're going to be down another, I don't know, $1,500 or something like that, maybe more, who knows, whatever. But the point is we got to figure out what we're going to do now, right? All right, so here's what it all came down to. The shares plunged as much as 19% after hours trading as the threat detection technology company gave a fourth quarter sales forecast that fell short of Wall Street's expectations. We're talking about one quarter falls short, 20% drop. Crowdstrike said it expects fourth quarter revenue to be in a range of $619 to $628 million, while analysts had earlier forecast company sales to reach $634. So they're coming up, on the high end, $6 million short, which they generally beat their own guidance, and so they'll probably come in right around $634. Maybe a little under, who knows. While its revenue outlook fell short of analyst estimates, it also forecast earnings, excluding one-time items, of 42 to 45 cents, which surpassed estimates of 34 cents. So what does that tell you? They're getting more efficient, right? And so that's actually a good thing. And so when I just seeing this right here, I need to look at the rest of the report. But when I look at this and I see a company getting more efficient, more profitable on less revenue, I actually like that. And I think that as long as they're not losing market share, as long as the market's not dying, the product's not dying, they're losing customers, this could actually be a fantastic opportunity to add shares if it's at the right price. Because right now, just looking at this, the thesis is not broken. We're talking about they actually beat expectations this quarter. They're going to slightly miss next quarter in a tough macroeconomic environment, but they're creating a more efficient company and a more profitable company. I actually like that long term. Okay, for its third quarter, Crowdstrike reported profit excluding one-time items of 40 cents on revenue of $580.9 million compared to analyst estimates of a 32-cent profit. So they beat on EPS and revenue of 575. So they beat revenue by about 5 million. Highlights for the quarter included addition of 1,460 new subscription customers, bringing it to a total of 21,146 subscription customers. I mean, just look at this. Revenue grows 53%. Annual recurring revenue grows 54%. Record cash flow from operations of $243 million and record free cash flow of $174 million. I love this report. The founder and CEO did call out some struggles, right, or some challenges. Total net new ARR was below our expectations as increased macroeconomic headwinds elongated sales cycles with smaller customers and caused some larger customers to pursue multi-phase subscription start dates, which delays ARR recognition until further quarters. As a platform consolidator with industry-leading efficacy, we differentiate ourselves from the competition and empower customers, which we believe positions us to capture enduring industry trends and generate durable long-term growth. So, no ifs, ands, or buts about it. This is a tough economic time. Even in security, they're seeing it, but this company's not going anywhere. They're not going out of business, and it's just a tough period, right? This is what makes investors. You either get scared and panic out, which, do what you want with your own money. But I can tell you right now, I'm not selling my shares. And in fact, I'm going to consider buying. And then again, cash and cash equivalents, $2.47 billion as of October 31st, 2022. GAAP net loss was $55 million. And so, if they lost that every single quarter, times 4 quarters, you're talking about 200, 210, 220 million, whatever. That's like 10 years of those losses that they have in cash and cash equivalents. So again, this company's not at any risk of going anywhere. Okay, here's a quarter at a glance. Again, we talked about a lot of these numbers. 60% of their customers have 5 or more modules. That means they're not churning anywhere. That's a lot that they're running with their business on their platform. 83% free cash flow rule of 40, that is elite, and then $90 million in non-GAAP operating profit. And $25 billion total addressable market at IPO. 2023, they're saying $76 billion with their current portfolio in 2025 at $98 billion. And then potential TAM with planned offerings of $158 billion by calendar year 2026. Again, just look at the growth here, right? From 71 million in first quarter of 2018 to 2.3 billion in the third quarter of 2023. Just incredible. And that's their subscription ARR. Okay, and here we go. Dollar-based retention rates for subscription ARR 1 year prior cohort. So that means current customers, how much they're spending in the next year. They have 120% benchmark. They want them spending, 20% more from 1 year to the next. They're at 123%, which is actually up a little bit. They got as high as 147 back in 19, but still anything over 120% is awesome. Gross retention is at 98.1%, which is just fantastic. Gross margins are staying solid at between 76 and 77%. And here's their long-term target operating model, right? This is a beautiful business, and it has the ability to be a very cash efficient business. Subscription gross margin 77 to 82%. Sales and marketing 30 to 35% of revenue. Research and development 15 to 20%. General and administrative 7 to 9%. Operating margin, that brings them to 20 to 22% operating margin and a 30% plus free cash flow margin. Again, that's their long-term target. And so finally, these will get updated and they'll get updated a little bit down. But if we just look at the valuation, right? If we look at, you can't really look at this company on a PE basis per se, but even if you look out a few years, out to 2026, 2027, you're looking at a 28 to 22 PE with a ton of earnings growth ahead. And this is still a company that's in hyper growth mode, right? Growing earnings 99%, 41, 46, 77, 20. So, very high double-digit earnings growth for a long time. Looking at revenue and price to sales is a better way to value software as a service type companies. They're turning in 54% revenue growth for the full year-ish of 2023. And they're expected to stay above, these are analyst expectations, expected to stay above 30% revenue growth through 2026. And just depending on what goes on with the economy, that could be extended longer. Maybe they have weaker revenue growth that's in the high 20s or something like that if there's a recession or whatever. But, this company and this market is here to stay. And so I foresee even revenue growth in the 20s for longer than analysts are expecting here. And if you just look a few years out to 2025, you're looking at a price to sales ratio of 8 with 33% revenue growth the following year, right? So that's a very reasonable price sales ratio. Yes, it got high. It's still a little bit high according to the stock market's reaction. So mistake on me for buying at such a high price sales multiple, but that doesn't mean it's a bad investment now. It doesn't mean it's a bad company. And so now I'm going to stick with it and I'm going to actually look to add opportunistically. I don't have plans to add immediately, although I might. I'll let you know. I'll report on this channel. Certainly not selling, and I'm going to do some more thinking and look at my current position size and if I want to add more over time, how big I want it to be. But, if I didn't own shares, I would be looking to start a position. Even though I do own shares, I'm going to be looking to potentially add. Now, again, I can't emphasize this enough. These are risky investments. You can lose money. I don't invest on margin. I don't invest money that I need in the next 3 to 5 years, any of that crazy stuff. We are in for some hard economic times, so the best thing we could do is be smart with our finances and cut excess expenses. But for me, the more money I can put into the market and the more I can save is what I'm trying to do right now in this economic time. Anyways, if you like these updates, if you like me sharing myself losing money and at least the transparency, the best way you could support this is to like the videos. That's free. And then subscribe to the channel. That's also free. And tell somebody you love them.